Hello everyone, it's David Harper from Hotel Partners Africa. The title of our talk is How to Secure Funding for New Hotel Developments, which I think you'll all agree is actually a very interesting and important topic. We are very, very lucky to have a distinguished panel with us of three great speakers. We've got, and what I'm going to do is I'm going to announce them to come up on stage. Hopefully they'll come on and then we can sit and ask some questions. So I'd like Edmund Asmoa to come on, Senthil Kumar and Amici Ndili, please. And we have two. I'll just start as we go through. So Senthil, who's the VP Operations of New Ventures with Kalyan, the owners of this hotel, and with desires for hotels all across the continent. We've got Edmund, who's just on the end there, the MD of ACE A&C Developments, who successfully developed a very good retail mall in Ghana, and they're currently looking to develop a new hotel resort in Ghana as well. And then Amici is the Chief Executive Operator of Lionstone Group and the Golden Tulip in West Africa, and they manage and lease hotels. So I think what we'll do is we'll let each of you just say a little bit about yourself, and then we'll start with some questions. So Senthil, would you like to just say a couple of words about your company?
Hi, Senthil. I'm the Vice President of Kalyan Group, in charge of operations and new ventures. I handle finance as well. Our group is more into diversification in all investments. We have diamond mines in Australia, property investments in Singapore, Australia, and India, fertilizer trading. We operate our own vessels. We have our own shipping company, and we have farming, large-scale farming, commercial farming in Africa. And now we are into hospitality. This is our first project in Africa, in hospitality. We wanted to expand more in Africa, to start more in West Africa. We're also looking for other opportunities outside West Africa. So this is a go. So we wanted to venture more into any infrastructure investments in Africa.
Edmund?
Hello. Yeah. My name is Edmund Asmoa, Managing Director of ANC Development. The core of our business is commercial. We've been doing mixed-use development, shopping malls, offices, etc. for 11 years. We're diversifying into the resort and hotel business. So for the past 5 years, our company has been land banking a lot of beach assets to start our first project, which is going to be a resort. So this is one of the areas we're very confident in Ghana. So we're planning to invest a lot in this sector as well.
And Amici?
My name is Amici Ndili. I am the founder and chief executive officer of Lionstone Group that owns controlling interests across a number of other investments. With respect to today, of course, I wear that hat, but I also wear the hat of Chief Executive Officer of Golden Tulip West Africa, which is a hotel operating company that operates hotels primarily under the Golden Tulip, Tulipin, Royal Tulip brands across Anglophone-speaking West Africa. Additionally, we just founded a hospitality academy called the Africa Hospitality Academy that trains young Africans for very senior leadership and management positions in the hospitality industry across Africa. So I hope that's a brief enough introduction. Thank you.
Fantastic. Now, our three panelists all have very different experiences, and I thought that probably the most interesting way of starting might be to ask them how they have funded particular projects, just if there's any tips they can give us, and then we'll ask, once we've had their stories, we can start to ask some real questions. So Senthil, for this property, how did you fund it? Where did the money come from?
This property, the equities is 100% from the promoters. the sell source. By the bank, we worked with syndication through the local bank, Bank of African Development, BOD in short. They did the syndication for us. We had a mixture of ECOWAS Development Bank, Bank of Africa, who's our agent bank, and we had BASIC and UTB. So we had a pool of bankers who helped us in raising the money in a quite quick time, considering the project completed in 16 months. So financing was a bit a prominent thing, and with the help of banks, we were able to do. The additional capital beyond the projection, it went beyond. That was also pumped in by the promoters.
And so basically the debt you got around about 35% equity you put in, 65% debt to start with. Was that from a local bank? Was that from a whole syndication all across the world? I mean, was there any ways that you made it affordable to put 65% debt in? Because a lot of projects, people struggle to get more than 40%. You know, they have to put more of their own equity in.
No, our debt part initially was 65%. Equity was 35%.
Yeah.
But we did approach banks outside the region. But the difficulty we faced is the currency risk. It was a major setback for us. Even though the interest rates outside the region was much lower, there was an additional cost of hedging, and you cannot hedge for a 10-year period on a currency. So we prepared a document. We have a internal team, a risk assessment team who are ex-bankers. So we know what expectations a bank would look for in funding such projects. So we do our homework. We take a bit of time before submitting, before we approach a bank. So that's a key thing. That's helped us to get that funding.
Yeah, no, excellent. I think we'll come back to that in a little bit, because I think that's a very important topic, how to approach banks properly. Edmund, on your resort, you are presumably looking for funding now. How did you get the equity for it? How did you get the debt for it? And is it any different to how you found it for the retail mall, which you've obviously successfully done very well? I mean, across large parts of the world, funding procedures for retail is very different from hospitality.
Yeah, definitely. In regards to funding, if it's the commercial side for us, we don't have any issues getting investors or debt financing. But because we're diversifying into the hospitality sector, especially resort, the resort industry in Ghana is very virgin. So as far as investors coming on board, it's not that many that are very confident about the market. So what we're having to do is obviously pull our resources and inject a good portion of our cash into the project. Debt financing, honestly, realistically, in my market, is impossible in the sense that the rates are ridiculous. I mean, you're looking at about 25 to 30%. You're basically crucifying yourself if you're going into that type of financing. So what we try to do is we look at outside financing. We have a relationship with some foreign institutions. So we'll probably have to bank on those. And we have some silent investors that are very confident about the product and feel it's very viable. So we're looking at tapping into that as well. But what eventually is going to end up happening is we're probably going to inject, I would probably say 60% equity into the project. And the way we'll have to do that is we can't take on a large scale. We kind of have to graduate it, start on a small scale and graduate it, so that at least once you're successful on a small scale, and in this size, we're talking 20 acres, we're looking at about 11 executive and about 60 units. So for that is manageable because we're injecting so much cash. Then once it's successful and it's doing very well, then obviously it's easier to now pull in bigger investors on a larger scale. The good thing we've done is the project is scalable, so we have a lot of assets to grow into that. But there are some challenges from private equity investors and debt financiers.
One of the problems that we tend to find is when you've got a fair amount of equity, but you need just a little bit more, sometimes those equity investors can hold out for some, a larger proportion of the deal than they should be after. So it's all about careful management. Amici, up until now, your model has more been that you're managing hotels, you're sort of maybe taking leases, etc. So some of the capital investment you've needed to upgrade some of the properties has been slightly less. How have you funded that?
That's a really good question. Let me start by saying that we generally do not take on debt. For one of the reasons that we just heard now, Edmund's reason, for example, is a critical reason why we try to avoid debt. At 20% interest rates, you will literally double the principal amount in 4.5 years. Okay, so this makes no sense, especially if you are building greenfield. Okay, just the development time scale will mean that the project will cost you in financing terms twice as much as you borrowed if you build it in 4 years, which is even in our part of the world not even a very realistic time scale. So we stay away from debt, and we tend to fund things out of our own cash flow. And the place where we find the most interesting returns and the most interesting kind of investments are in the mezzanine space, or the mezzanine slice, if you like, of the capital structure. Part of what happens is that when hotel developers or hotel owners start a project, they tend to under budget. Sometimes they get the budgeting right, but they forget that they've got to have 3 to 6 months of working capital in place, banked and ready while the asset becomes cash yielding. And it's really in that space that we find the most interesting opportunities, where we step up and kind of provide the mezzanine slice to get the asset across the line. And we found great joy with this kind of funding and capital structuring. The equity owner doesn't sometimes want to share equity. They go to the bank. It's extraordinarily high cost capital. And the bank asks for an arm and a leg, and they usually have already given away the arm and the leg in the process of getting to that point. So we kind of come in as, kind of a soft funder. And that capital that we use comes off our own balance sheets.
So how do you decide where you're going to borrow the money for your own balance sheet? Why do you decide on certain properties that you will help them with this injection of mezzanine? And how do you structure it so that, because you're not getting a slice of the equity with that mezzanine, and you're still behind any debt that's there, how do you make sure you're in a good position with that funding?
Well, that's where the operating platform comes in, okay? At that point, the owner really wants to get complete because he's already in a hole. He's already in a big hole, and this is sort of cross the line capital that happens. The first thing, of course, is that as operators, we underwrite. You underwrite just the way that any funder or lender will underwrite both that asset and the market. It's kind of, let me make just a very small and interesting point here, because we always talk about these feasibility studies and underwriting, and it's kind of a check the box thing, but it should really be more than that. This industry is unique in the sense that you build these very expensive assets and you rent them on a day-to-day basis. Okay, so if you were a real estate landlord, you would never really do this. Okay, you would not build an apartment complex and take, renters for the day, sometimes for a few hours. Okay, so it's kind of a complicated business. And because it's complicated and you don't have an end user, it's not like project finance where you already got an end user and you sign up for all that. The end user effect is in the underwriting, it's in the feasibility, and it's in doing that with an excruciating amount of detail. Now, as an operator, you tend to already know the markets that you're in, okay, because you've got either a similar asset or a similar experience somewhere else, and that becomes useful. Now, the second part of your question, and I'll just finish up very quickly, is how do you control that whole process? Now, if you are the operator and you are providing mezzanine financing, then you come directly behind the bank and ahead of the equity provider. And because you're operating the asset, you see the cash flow, okay? And you have some measure of control over the cash flow, okay? Typically, the bank will say, pay me first, okay, which you do, and then you take the second slice, and then you say to the equity holder, well, here's the balance, all right? And because you are controlling that, the cash flow, you can do that.
That's very handy. Senthil, could you give us some tips on how you would approach a bank? If you were to go for a new project, let's say you're going to buy a lovely hotel in Luanda, for example, how would you approach the bank to say, what I'm after is 60% loan, 65% loan, whatever it is, this is how, why you should lend it to me. What would be your approach?
First, we study the country. What does the bank expect from any investment that happens in that country? What is the interest rate? What are the other options that you have before approaching a bank? And then we go into a detailed financial feasibility first. Then we vet, like I said earlier, we vet through our internal risk team. Then we go through, we have a checklist of each and everything, what a bank would expect. So we prepare our documents, and the approach towards the bank would be more friendly. Whatever information we provide them beyond what a bank would expect, so that there is no question back thrown at us, okay, what is this risk? Have you covered this? Have you covered that? And we look for guarantees that the bank would expect, because in this part of the world, the banks would not willing to take much of risk. They want maximum collateral for any debt they provide to any investor. So we, even during contract negotiations with, for a lease agreement with the government, or if you're own property, we make sure that we have enough collateral to provide to the bank, so that the bank is much more comfortable to lend you that money.
So you basically cover off who you are and why you're a good risk, why the property's a good risk, maybe by having a good operator in there, having feasibilities and valuations that show it's worth doing, and then the country risk elements, you cover those off with your political, where you take your insurance out on political risk and things like that, yes?
Yes, because the country risk is a primary. When we look for any investments, the first thing we look is the country risk. We have a consultant, Pricewaterhouse, so they do a country risk assessment, and then we go into the properties, what exactly is a property about, freehold, leasehold, the nature, and then we check on the legal things first, and then we look into the financial part of it. So it's a lengthy process, but we spend more time into preparation work before approaching a bank.
Edmund, your project's slightly different because you've got an awful lot of equity in it. Where do you go to find equity for a project like that? Where is the money coming from? Is it all from Ghana? Is it all from high net worth individuals, or are there various different sources that we don't know about that perhaps you could share with us?
I mean, the equity is definitely coming from local sources, high net worth individuals. We're also looking to partner with, hopefully find a partner, because we know that there's scalability to it. But, like any project, it has to be proven and tested. So usually we like to just take the approach in injecting our equity and bring in some strong investors that are confident that you can deliver the product, then take it from there. As far as international investors coming in, it's extremely hard to convince them because they don't understand the local market. My experience with a lot of them is the requirements are just too long. They tend to bring requirements that fit their markets and try to duplicate those templates into our market, and it just doesn't work. So a lot of the feasibility studies or statistical information they might need, even though you have consulting companies that can do it, it's not as detailed because you've got to remember it is still an emerging market. So some of the data that they might require might not be the same as what will be required in a Western market that is very mature. So we tend to find that dealing with a lot of the international investors can prove very, very difficult. Whereas talking to local investors, high net worth, simple, they get it, they understand, they know the local market, and they're confident that it will work. So the reality in a lot of these cases is a lot of the times when you start a project like this, since it's a different sector for us, it will be local high net worth individuals. When it's successful and it's making a lot of money, then the international investors are interested.
So initially then, we're going to have a number of different local investors that will come in. When you've got one equity investor or two equity investors, it's very easy to set up a structure that works where we all know what our responsibilities are, what rights we've got. When you've got multiple investors, that must be very complex. How do you sort of make it so that it's easy for you as the promoter of it to actually still control the whole process rather than almost having to have, a referendum on each decision that's made?
In situations like ours, we tend to try to minimize it to just one or two investors because the bulk of it will come from us in our particular situation. But if I can find one solid investor that shares the vision, shares the direction, I'd rather go that option. It's just less work dealing with multiple investors. And that's why, again, I say it's a scalable thing. You kind of manage your cost on the first project, so it's not too aggressive, and the capital required is not overly ambitious, so that you can prove that model. But the key thing for a lot of investors, like I said, is scalability, knowing that, okay, this phase worked very well, I can move on to the second phase, because once you've built the first phase successfully, going to the second phase is very easy, because you could just carry on the success of that into the second phase. So in our market, I'm talking specifically with Ghana, that's really the approach. I mean, that's how we approached it with the mall. When we initially started the mall 11 years ago, no one would give us money. So we had to inject our own cash. And because we phased it and it proved successful, then we started to get financiers. One of the financiers is IFC that came into the project because we've proven the model, we've proven that it worked. But it was a process that we had to scale over the years and prove the success of it. So I think that's very important for emerging markets. And there's a lot of indigenous entrepreneurs out there trying to figure out, because that is their biggest challenge. They have amazing ideas, they have the land assets, but raising the capital is their challenge. So the best approach I usually let them know is scale it. Don't try to build anything too excessive. Phase it out, start with the first model, make it successful, and that way you own majority of the equity in it. So when you go into the second phase, it's more bankable.
Perfect. Okay, we're running towards the end of time, and I want to get some questions out to the audience. The last one, I'm just going to aim at Amici and Senthil just quickly, and that is there a difference between raising debt and equity for an existing property, if you were to buy an existing asset, or if it was a development? Can I start with you, Senthil?
Um, yeah, there is a difference because with an existing property, you easily know what is the revenue that it generates. You have financial numbers in front of you. Then you can do a valuation on it, and then you said, okay, it's worth X or Y, and you pay the negotiations you do. So it's easy to approach any investors because our future projects, we have our partners we have own private equity fund based out of Malta and Ireland. So we have our partners who raise money through private institutional investors and family offices and high net worth people. It's easier to approach a fund for equity for an existing property than starting from a greenfield. For a greenfield, you need to convince a lot of investors, but with an existing one, it's much more easier.
Yeah, with the track record there, it's easier for them to bet for it, yeah. And Amici, your experience? Because I know that you may potentially be looking to buy some assets now, so...
Well, my experience teaches me, of course, that they're fundamentally different things between raising capital for an asset that is cash flowing or cash yielding than an asset or a situation where you have to develop. When you are developing, of course, the funding institutions will have to underwrite even the developer. Okay, well, do they have the capability to take the whole thing to the end? Have they budgeted properly? It's just a layer of complexity that it can be taxing. And the second part of it, of course, is that there are fewer people in that capital providing universe than there are in the universe where the asset is already cash yielding. When it's cash yielding, now you're, of course, you're still, underwriting markets and assets, etc., but you have a measure of certainty around the volatility in the cash flow movement. And because you have that, it's just easier to underwrite. You will find a bigger universe. You are looking for just a cost of capital differential, okay, that allows that asset to continue to return some money to the equity holders and to the bankers, whoever. So in a nutshell, yes, the universe is larger and the discussions are easier.
Thank you very much. Okay, we've got time for one question from the audience. So is there anyone who's got a burning question we'd like to ask any of the panelists? No, I think that's us done then. So can I just ask you all to say thank you very much to my panel?
Thank you, guys.